Hello and welcome to Trading 5 Talents. This is the question that I want to try and address today, and that is, if you just go long on SPY, or at least have a bullish sentiment and have a bullish trade on SPY, is it really easy money? Is it really easy profit? This idea, it's not a novel idea whatsoever. However, it just started thinking about it more recently. So for the past 30 years, this is what SPY has looked like. Every bar here is a month, and it goes back all the way to 1993. And you can see, the price action of SPY. Now, the reason that I started thinking more and more about this is twofold. So the first thing is something that Warren Buffett has taught for quite a while, and that is simply investing in a low-cost mutual fund over the long term. And that was summarized by this CNBC article that was written, looks like last year. And the title of the article is Warren Buffett says monkeys could do as good a job investing as Wall Street financial advisors. Now, in the first paragraph, it says, legendary investor Warren Buffett calls investing a simple game that financial advisors have convinced the public is harder than it really is. And scrolling down here, I just wanted to pick up these last three paragraphs because I think it really highlights what he's trying to tell the general public. And that is, Buffett has long recommended that investors put their money in low-cost index funds, which hold every stock in an index, making them automatically diversified. The S&P 500, for example, includes big-name companies like Apple, Coca-Cola, and Amazon. Buffett previously told CNBC that for people looking to build their retirement savings, diversified index funds make the most sense practically all of the time. Consistently buy an S&P 500 low-cost index fund, Buffett said in 2017. Keep buying it through thick and thin, and especially through thin. And we can see why this was such great advice. Just by looking at the chart for the past 30 years, S&P has simply gone up. Now, that was the first piece of information that really, got me asking this question of how easy is it to make profit just by going long on SPY. The second piece of information came by way of a comment about a week and a half ago, and that was from Jason Reviews, and he said, SPY, 90 DTE, put spread, get out 21 days, wins most of the time, set trades weekly. So I thought, this is something I can actually test using Option Alpha's backtester, which for the most part with my strategies, it has been limited in many ways. But with this one, I can easily test it. And so I wanted to test it. So if I can couple these things together, instead of buying SPY and just investing for the long term, can I actually use a put credit spread, this long-dated put credit spread, and just let theta decay work for me in this bullish trend? Again, you can see here 30 years. There have been some drawdowns right here. You can see the dot-com bubble, the housing bubble, COVID, and then the economic crisis here in these red arrows. But overall, the progression of SPY is from low to high. It just keeps on increasing, even though there are some setbacks. So can we use this to our advantage for those that are looking for a passive income stream? So going long on SPY, here are the bullish strategies that I wanted to test. So first of all, just buy the ETF of SPY. You're just long on SPY. So what's the advantage? There's no theta decay because you're actually owning shares. The disadvantage, however, is that the profits are very illiquid. You're invested, you have your capital gains, and it's unrealized until you start selling shares off. Yes, there are dividends. That's another advantage here. There's better tax advantages. That's another advantage here. But the profits are very illiquid. Depending on your trading and investment style, this may be just the thing for you. The other thing you can do is just go and buy long calls. So there's more leverage than buying shares of SPY because we know options are leveraged. The disadvantage, though, is that there's a lot of theta decay because you are just long on a single option. The other thing you can do is just purchase these long call spreads. So this is going to cost you less than just buying long calls outright, but also there are going to be smaller profits and, of course, double the commissions because it's a spread rather than just a single option. And then finally, the other bullish strategy for SPY is short put spreads. And I believe this is what Jason Reviews was getting at in the comment, these put spreads, 90 DTE. You can benefit from theta decay here. But also there's going to be smaller profits and more commissions, just like the long call spreads. So these are the four strategies that I wanted to test in the backtester using Option Alpha. So I wanted to determine which of these four bullish SPY strategies was the best for my trading goals, which is to generate passive income. So what does the best mean? And I put that in quotations because it's not simply the one that has the highest profit. The best strategy is going to have an optimal balance, as optimal as it can be, of the total profit and loss. The win rate has to be pretty high. The risk has to be low. The return on capital has to be high. I would prefer the duration to not be too long, and I don't want the drawdown to be too long because obviously a huge drawdown could have some pretty significant emotional consequences if you're a trader and you see those big red numbers. So with each of these back tests, I'm going to start with $5,000 of paper money. I'm going to trade one contract or one spread each week. And so I'm using that weekly strategy that Jason Reviews had mentioned in that comment. And so I'm going to be looking at the deltas of the options. I'm going to be testing different exits, different profit targets, different expirations, also the presence or absence of the indicators that are available on Option Alpha's backtester. And so I want to see if any of those, enhance or take away from the optimal balance of these different metrics that I'm testing. So I also want to look at how long these results can last for. I'm going to backtest 1 year, 3 year, 5 year, 10 year, and 16.5 years. So why 16.5 years? Well, if you choose all time in the backtester for Option Alpha, that's how far back it goes. So that's as far as I can test with Option Alpha. And of course, I'm using Option Alpha's backtester. So I'm going to summarize just by choosing the best one from each strategy style. So basically the one that had the best balance of these metrics that I'm testing, and then comparing those four to each other and see which one, I would prefer. So let me just show you an example of how I'm testing it. In the top left corner, you can see the Option Alpha backtester screen, and I'll go over more of that as we get further into this video. But I looked at 57 different iterations comprising of 4 strategies. Now with Option Alpha, as the name implies, I'm only testing the 3 option strategies. I'm not testing the long SPY because that one's pretty easy. Just buy it and then see what you end up with, so many years down the road. So I'm just testing just the 3 strategies, 3 option strategies, and then 57 different iterations amongst those 3 strategies. And I'm ranking them according to, again, total profit and loss, the drawdown, the Sharpe ratio, the win rate, etc. And the one that is the best gets ranked number 1. The one that is second best gets ranked number 2, and so on. And then I am adding all of those ranked values together. And of course, the lowest number should be the best. If a strategy ranked number 1 in all categories, then 9 would be the lowest possible rank. Of course, I didn't get a 9, but I got low numbers and I got high numbers. So I'm going with the one that had the lowest numbers of each set. So let me show you some of these metrics that I'm actually looking at. So I've zoomed in so you can see that I just call this the weekly bullish SPY strategies, and I started this with a 5-year back test, and then I also went to the 1, 3, 10, and then the all time. But this is just showing the 5-year backtest results. You can see the rank is over here on the left. I'm looking at DTE. These are all the short put spreads, short deltas, long deltas, profit target, whether I had one or didn't have one, whether I had a stop loss or didn't, the DTE exit. Jason Reviews recommended 90 DTE exit 21 days prior to expiration, whether or not there was an indicator that was on. And then with the results here, the average duration, the ROC, total profit, max drawdown, the profit factor, the Sharpe ratio, total positions, win rate, and then the best and worst and the averages of the wins and the losses. So combining all of those factors together and then ranking them and then adding all their ranks together would give me this number over here in the left-hand column. So the numbers that are green are the ones that worked better than the numbers that are in red. And if they're orange or yellow, then they're somewhere in the middle. So as I scroll down, you can see some of them start turning green because these are the ones that are going to be working better, again, quote, better than the other strategies based on a combination of all of these metrics. Okay, so that's what all of this data represents. Now, of course, it's going to be kind of messy because there's so many numbers, so that's why I just summarized it in a graph. Right, so here are my initial findings from running all of these back tests. First of all, for the option strategies, 45 DTE always work better than the 90 DTE. The 30 and 40 delta ratio was the best combination of all the deltas that I tested. And that holds true both for the long and the short spreads. I also found that having no stop loss worked better than having a stop loss. I found that increasing the profit target from 25 and then ramping up in either 5 to 10% increments, so going from 25 to 75, by increasing that profit target, it increases, of course, the total P&L, which is good, but it also increases the max drawdown, which is bad, and it also decreases the win rate, which is bad. So here are the things that I found work the best over all these option strategies, and this is what I used going in to make these head-to-head comparisons. A 45 DTE, a 30/40 delta, whether it's a long or short, it doesn't matter, and then no stop loss, and then a 25% profit target. So if I put those parameters in a long call, in a short put spread, or a long call spread, those parameters work the best. Now that I've done that, I can make a better comparison for these 4 different bullish SPY strategies. Before we get into those results, let's look at what happens if we just buy SPY shares, and if we start with $5,000. So when I made this video, the current SPY price was $453.72. A year ago, it was $393.55. So I could have bought 12 shares, and that would have netted me $722.04. Now, if I would have bought SPY 3 years ago, the price was $322.54, and I could have bought 15 shares with $5,000, and that would have netted us $1,967.70. 5 years ago, SPY's price, I could have bought 17 shares, and this is the profit as of today. 10 years ago, this was SPY's price. I could have bought 29 shares, and this would have been the profit today. 16 and a half years ago, SPY was $141.71. I could have bought 35 shares and I would have had over $10,000 in profit today. So like I said, just buying SPY ETF shares, it's a very simple calculation. You just have to know what the price of SPY was X number of years ago. So how does that compare to these different option strategies? So these are summarized as follows. So first of all, in this graph, you've got 4 different color sets: the green, the blue, the purple, and the orange. The green is just buying long SPY shares. That's what I just showed you on the previous slide. Each of these groups here represent 1, 3, 5, 10, and 16 and a half years. So you can see with a long SPY, 1 year ago, 3 years ago, 5 years ago, etc., it just goes up. That makes sense. Same thing with the long call spread, and the short put spread. We can also see down here with the 3 option strategies, these 3 on the right, I have the DTE, the long delta, the short delta, the profit target, and the exit. And I already mentioned the optimum parameters for those earlier in this video. The first thing that we can take away from this is that just by going long on SPY, just by buying the shares of SPY, it simply outperformed either of the 2 spreads. It beat out the long call spread strategy, and it beat out the short put spread strategy. So yes, we might have been able to increase the profits of this, but then at the same time, we might be increasing the drawdown. We might be increasing the risk. So these were the optimum ones that I am plotting right here. All right. And then next is the long call. So if we just bought long calls on SPY, this is the result of it. So 1 year, yes, it beats it. 3 years, yes, it beats long SPY. 5 years, yes, it beats long SPY. 10 years, yes, it definitely beats long SPY. But if you go for all time, all of a sudden you have a negative value right here. In looking at all of the backtest data for this, this is what happened to generate this red bar down here. That red bar in the long SPY strategy happened right here during this housing bubble pop. So what happened was that the strategy was profitable, and then all of a sudden it went on a very long losing streak for about 2 years. It lost all of its money, so it was a negative $5,000 because that's what we started with, and therefore it could not enter in any more trades for the rest of this recovery period right here. So if we only went back 10 years to 2013, you can see, yeah, we started, in the perfect time, right at a bull run. But even during this crash down here of 2020, this crash down here in 2022, it still outperformed long SPY. Yes, there's a cautionary tale in that if you are running a bullish strategy in a bear market, then yeah, you're not going to do very good. We should also hopefully be able to determine if we are in a long-term bear market and just not run that particular strategy. So if that's the case, even if you missed it right here, there is still a quick recovery. And if you forgot to not run that strategy up here, you still would have been doing a lot better than if you were just in long SPY or you were just out of the market. So let me show you what this backtest data looks like for this long call strategy. Okay, over here on Option Alpha, I'm on the Backtester tab right here, and you can see all of these different backtests. Now, I had 57 sets of data, but I only have 33 backtests here. And that's because I was just able to modify one particular backtest, and I was able to get, 4 or 5 iterations worth of data out of it. That's why the numbers don't line up exactly. So the one that I wanted to look at was this one right here. This was the long call on SPY, 45 DTE, and then this is a 40 delta. 5-year backtest, $5,000, and then we simply enter in once a week. And then we exit at 25% of the 25% profit or 20 days until expiration. And then there's no stop loss. So you can see that it was a very good win rate, almost 75% win rate. There was 261 trades. The best win was 1081. Worst loss was minus 842. Average duration was just over 11 days. So this performed very well over the last 5 years, and even over the last 10 years, this one performed very well. But when you go to all time, you can see this is what I was talking about. So down here, in 2008, during the housing market crash, this is where it lost its money because it kept going long on a market that was actually in a bearish trend, and you lost it all. So lost $4,882. You couldn't enter in any more trades during the recovery period, and therefore this would not have worked well. So if you just had the foreknowledge to not run this strategy in a bear market, when you see all of the news of how bad the economy is doing and how strongly the stock market is going down, then you just don't run this strategy. And I think if you could do that, which again is a very big if, because there's a lot of contrarian traders out there, or you think the market's going to turn around, then if you can do that, then I think this would be a preferable strategy. So if you can just not trade this particular strategy during a market in which all you hear is the negative news of the economy and the state of the stock market and American companies, then you just don't trade this, and you could probably save yourself a lot of pain and a lot of loss by just going long when the conditions are right. Now, when are the conditions right? Well, the conditions are right the majority of the time. And just like Warren Buffett was saying, you just buy a low-cost, index fund practically all of the time. And that's exactly what I'm showing here, but you can maximize it with going long on the calls, specifically 45 DTE, exit 20 days before expiration, and take your profits at 25% with no stop loss. So to me, that sounds like it is pretty easy. So let me give you a few other conclusions and tell you what I plan to actually do. First of all, if I had to pick between a long call spread and a short put spread, I would go with a long call spread. The reason, based on the back test, it just has less risk than the short put spreads. Secondly, if I had to choose between a long call and a long call spread, I would definitely go with a long call spread. The long call has a higher ROC than the long call spread. If I had to choose between just buying SPY shares and going with a long call, then I am choosing the long call because the realized profit is liquid. After 11.3 days, I think it was, the average hold for these call options, every 2 weeks, you're getting some cash back into your account. Every 2 weeks. With long SPY, you have to keep that money invested until you're ready to sell off shares. Then you can have your profit back. The second reason is because the profit is realized much faster than just holding SPY shares. And you see that right here in the graph. So even after 1 year, you're already at worth, 5 years worth of holding long SPY. Here at this is 3 years, you're already further along in terms of pure profit than SPY was at 16 and a half years. So for those two reasons is why I would choose just this long call strategy. It's very basic. It's very simple to just enter these long calls every week, once a week. The other thing that I am interested in doing with this right here, if you are in a bear market and you're trying to run a bullish strategy, yeah, you could be wiped out very easily. But because I'm using this for passive income, I'm not trying to build my account so large that, it's just all in my account for no reason. I want to take money out every month. Let's say I start with $5,000. Every time it gets to $6,000 or $7,000, I want to take that, $1,000 or $2,000 in profit out of my trading account, use it for my monthly expenses, and then start again. Build it up another couple thousand, take it out. Build it up for another couple thousand and take it out. That way I'm actually using my profits. And if I lose that entire 5,000, hopefully I don't, but if I did, then at least I got to enjoy my profits along the way. So yes, this can be a scary thing right here, this red candle, after so much gains, but that is continually buying more and more with the profits that you're not using. You're just leaving it in your account. So if you can trim off these profits along the way, then I think you'd be in a better situation. And that's what I'm planning to do. So I made this bot over on Option Alpha. I just called it the weekly SPY call. And it only has two positions, one open and one closed. But if you look at the positions right now, one closed a couple days ago for $166. This one still has 49 days left in the expiration cycle. It's up $3. Now, even though I said 45 DTE, when you put that information into a bot, it's at least 45 DTE. So if it's less than 45 DTE, it's going to go out to the next week, which adds another 7 days. And that's what happened here. That's why it's a 49 DTE. Yes, SPY has expirations every day, but when you go out that far, a month and a half or so, then you don't have everyday expirations in the options chains. You have them weekly. So that's why it's not going to be exactly 45 days every time. But this is a very simple bot. There's not much data here, but I'm basing it off of all of the backtesting data that I just showed you. So how simple is this bot? If you look in the settings, it's just on a trigger. Every Monday, 10 a.m., enter a weekly call. And this is it. If you haven't opened a position this week, then go ahead and open this one. SPY, at least 45 DTE, 40 delta, one contract. It checks if it has enough capital. And then, of course, my exit options. And my exit options are also very simple. Right here, it is 25% profit or 20 days before expiration. And then, of course, wait at least 1 day to avoid pattern day trading, which I don't think it would ever hit 25% profit this far out, but just in case. And that's it. It's just a very simple bot. Now, that's why I asked that initial question, can it be this easy? And hopefully you'll follow along with me as I continue testing this to see if it is this easy. And we have the back testing data to support it. And we just need this forward testing data to further support it and confirm it. And then we can go live with it and see if we can't make this passive income by going long on SPY. Until next time, trade wisely and take care.